Something's happening in the silver market right now that most investors are completely missing. And I'm not talking about the price action you're seeing on the surface. I'm talking about what's building underneath, a structural setup that hasn't existed in decades. Let me show you what I mean. Silver just crossed $60 per ounce. That's a 130% gain this year alone. But here's what's fascinating. This isn't speculation driving the price. This isn't retail investors piling in. This is something far more fundamental, and it's creating a situation where the price could move vertically in a way we haven't seen since 1980. The silver market is experiencing its fifth consecutive year of structural supply deficit. Think about what that means. For 5 straight years, the world has consumed more silver than it's produced. The deficit this year alone is projected to exceed 200 million ounces. That's not a small gap. That's roughly 20% of annual mine supply, just disappearing. Where's it going? That's the critical question. Industrial demand hit record levels, consuming over 665 million ounces. Every solar panel installation, every electric vehicle, every 5G network expansion, they all require silver. And unlike investment demand, which can reverse, industrial demand is structural. Once that silver goes into a solar panel or an EV, it's gone. It's not coming back to the market. But here's where it gets really interesting. The supply side is breaking down in ways that most analysts aren't fully grasping yet. Global mine production has essentially plateaued. We're not discovering major new silver deposits. The easy silver has been mined. What's left requires deeper drilling, more complex extraction, higher costs. And here's the kicker. Roughly 70% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. So silver supply is actually constrained by the economics of completely different commodities. When copper prices are weak, mines slow down or shut down. Less copper mining means less silver production, even if silver prices are screaming higher. The market can't respond to price signals the way a primary metal can. It's structurally inelastic. Now layer on top of that what's happening with above-ground inventories. COMEX silver inventories have been declining steadily. We're seeing drawdowns that suggest physical tightness in the delivery system. The London Bullion Market Association is reporting similar patterns. And this is happening while industrial demand remains at record highs and investment demand is starting to wake up. Let me paint you a picture of what happened in 1980, because there are eerie parallels. In 1979, silver was trading around $6 per ounce. Within months, it exploded to $50. That's an 8x move in less than a year. What drove it? A combination of inflation fears, currency debasement concerns, and yes, the Hunt brothers trying to corner the market. But the underlying condition was a supply-demand imbalance that created the perfect environment for a squeeze. We're seeing similar conditions now, but the fundamentals are actually stronger. Back then, industrial demand for silver was a fraction of what it is today. Silver was primarily a monetary metal and a photography input. Today, silver is absolutely critical to the energy transition, to electronics, to medical applications. The industrial bid is permanent and growing. And here's something most people don't realize. The amount of silver required for solar panels has been increasing, not decreasing. You'd think technology would find ways to use less silver, right? But the efficiency gains from using more silver outweigh the cost savings from using less. So even as solar installations grow exponentially, the silver intensity per panel is going up. Electric vehicles are another massive demand driver that didn't exist in 1980. Each EV uses roughly twice as much silver as a traditional internal combustion vehicle. And we're not talking about a niche market anymore. EV sales are projected to reach 30 million units annually within a few years. That's an additional 30-40 million ounces of silver demand just from the automotive sector. 5G infrastructure is consuming silver at rates that weren't even imaginable a decade ago. Every cell tower, every base station, every connected device, they all require silver for conductivity and reliability. Add it all up, and you're looking at industrial demand that's not just strong, it's accelerating. And it's competing with investment demand that's starting to recognize what's happening. Now let's talk about what central banks are doing, because this is where the story gets really compelling. Central banks have been accumulating gold at record pace. Everyone knows that. But what's less discussed is how that gold accumulation signals a broader loss of confidence in fiat currency systems. And when that confidence erodes, it doesn't just affect gold. It affects all hard assets, especially silver. Silver has always been gold's more volatile cousin. When gold moves, silver tends to move further and faster. The gold-to-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, has been historically around 15 to 1. For most of the 20th century, that ratio held relatively stable. Right now, that ratio is around 85 to 1. That means silver is historically cheap relative to gold. If that ratio reverts even halfway back to historical norms, you're looking at a doubling of the silver price from current levels, even if gold doesn't move at all. But gold is moving. Gold hit new all-time highs this year, and as gold continues its march higher, driven by central bank buying, currency debasement, and geopolitical instability, silver is positioned to leverage that move. Here's something else that's happening beneath the surface. The paper silver market is showing signs of stress. The COMEX silver market trades enormous volumes of paper contracts relative to the physical silver actually available for delivery. It's a fractional reserve system, similar to banking. As long as most contract holders settle in cash rather than demanding physical delivery, the system works fine. But when physical demand increases and more participants start standing for delivery, the system gets stressed. We're seeing signs of that stress now. Delivery volumes have been elevated. Spreads between paper and physical prices have been widening. These are early warning signs that the paper market may not be able to suppress prices the way it has historically. And if we reach a point where the paper market loses credibility, where investors and industrial users start demanding physical metal instead of accepting cash settlement, you could see a price dislocation that makes previous moves look tame. Let me give you a real-world example of what happens when paper markets break down. In 2008, during the financial crisis, there was a brief period where you couldn't buy physical silver at anywhere near the spot price. Dealers were sold out. Premiums exploded to $5, $6, $7 over spot. The paper price said one thing, but if you actually wanted metal in your hand, you paid a completely different price. That dislocation was temporary because the crisis passed and supply chains normalized. But what happens if the dislocation isn't temporary? What happens if industrial demand, investment demand, and physical delivery demands all converge at the same time, while supply remains constrained? You get a vertical move. You get a price discovery event where the market has to find a new equilibrium at a much higher level. Now, I want to take a quick aside here because this is relevant if you're thinking about how to position yourself for what's coming. If you're sitting on $100,000 or more in retirement accounts, there's a strategy worth understanding called a gold IRA. It allows you to hold physical precious metals inside your retirement account without triggering tax penalties. I put together a free guide that covers exactly how this works, the rules, the process, the custodians that handle it. It's in the description below. Worth checking out if you're looking at ways to add hard asset exposure to your retirement portfolio. All right, back to where this price is headed and why the setup is so compelling. Let's talk about what's happening in China because this is a massive piece of the puzzle that Western analysts often overlook. China is the world's largest silver consumer. They're also the largest producer. But here's the critical detail. China is now a net importer of silver. Their domestic consumption exceeds their domestic production, and that gap is widening. Why does this matter? Because China has historically been a source of supply to the global market. When China flips from being a net exporter to a net importer, it removes supply from the global pool and adds demand. It's a double impact on the supply-demand balance, and China isn't just consuming silver for industrial purposes. There's growing evidence of strategic accumulation. The Chinese government understands the importance of hard assets in a world where currency wars are intensifying. They've been accumulating gold for years. It would be naive to think they're ignoring silver. India is another major player. Indian silver imports have been surging, driven by both industrial demand and cultural affinity for precious metals. Indian households have traditionally held wealth in gold and silver. As India's middle class grows and industrializes, both forms of demand are increasing. So you have the two most populous nations on Earth, representing nearly 3 billion people, increasing their silver consumption at the same time that Western industrial demand is hitting record levels. The supply side can't keep up. It's mathematically impossible given current mine production and the time it takes to bring new supply online. Let me walk you through what a supply response would actually require. To open a new silver mine takes 7 to 10 years minimum. You need to discover the deposit, prove the reserves, secure permits, arrange financing, build infrastructure, and then start production. Even if companies started today with unlimited capital, new supply wouldn't hit the market until the early 2030s. And here's the problem. Companies aren't starting today. Silver mining economics have been challenging for years. At $20 per ounce, many silver projects weren't economical. Even at $30, the returns weren't compelling enough to justify the risk and capital requirements. Now silver is at $60 and you'd think that would trigger a supply response, but there's a lag. Companies need to see sustained high prices before they commit billions to new projects. They've been burned before by price volatility, so they're cautious. Meanwhile, existing mines are depleting. Silver grades are declining. The easy high-grade deposits have been mined out. What remains requires more energy, more processing, more cost to extract the same amount of metal. This is why the supply deficit isn't a temporary phenomenon. It's structural. It's baked into the geology and economics of silver mining. Now let's talk about what happens when investment demand really wakes up. Right now, investment demand for silver is relatively modest compared to historical peaks. In 2011, when silver hit $49, investment demand was running at over 250 million ounces annually. Today, it's roughly half that level. Why? Because most investors have been focused on other assets. Stocks have been in a bull market. Crypto captured speculative attention. Real estate was booming. Precious metals were out of favor. But that's changing. Inflation is proving more persistent than central banks expected. Currency debasement is accelerating. Geopolitical instability is increasing. These are exactly the conditions that drive investors toward hard assets. And when investment demand for silver really kicks in, when you see the kind of retail buying frenzy that characterized 2011, the market simply can't handle it. Here's why. The silver market is tiny compared to other asset markets. The entire above-ground investment-grade silver inventory is worth maybe $50–60 billion at current prices. That's less than the market cap of many individual tech stocks. It's a rounding error in the bond market. So when even a small percentage of global investment capital decides to allocate to silver, it overwhelms the available supply. Prices have to rise to ration the limited metal among competing buyers. We saw this dynamic in 2020–2021 with the Reddit Wall Street Bets silver squeeze attempt. Retail investors tried to corner the silver market by buying physical and SLV shares. The attempt didn't fully succeed, but it did cause temporary shortages and premium spikes, and that was just a relatively small group of retail traders. Imagine what happens when institutional investors start allocating. When pension funds, sovereign wealth funds, and family offices decide they need hard asset exposure. When the narrative shifts from inflation is transitory to we need to protect purchasing power. The silver market can't absorb that kind of demand without a massive price adjustment. Let me give you another historical parallel that's instructive. What happened in 2008? In the depths of the financial crisis, silver crashed to $8 per ounce. Everyone thought the world was ending. Industrial demand collapsed. Investment demand dried up. It looked like silver was going to zero. But then something interesting happened. As central banks responded with unprecedented monetary stimulus, as quantitative easing became the new normal, as currency debasement accelerated, silver began a historic bull run. From that $8 low in 2008, silver climbed to $49 by 2011. That's a 6x move in less than 3 years. And it happened because investors recognized that the monetary response to the crisis was creating conditions for inflation and currency devaluation. We're in a similar situation now, except the monetary debasement is even more extreme. The amount of currency creation since 2020 dwarfs what happened after 2008. The debt levels are higher. The fiscal deficits are larger. The political will to address these imbalances is weaker. And this time, you have the added dimension of industrial demand that didn't exist to the same degree in 2008. The energy transition wasn't a thing. EVs were a niche curiosity. 5G didn't exist. Solar was a tiny fraction of energy production. All of those industrial demand drivers are now massive and growing. They create a floor under silver demand that didn't exist in previous cycles. So you have a setup where the fundamental demand is stronger, the supply response is weaker, and the monetary conditions are more favorable than any previous silver bull market. That's why the term vertical launch isn't hyperbole. It's a description of what happens when supply and demand curves become extremely inelastic and price has to adjust rapidly to clear the market. Let's talk about what the technical picture is showing because it's confirming the fundamental story. Silver broke out of a multi-year consolidation pattern. It cleared resistance levels that had held for years. The breakout was accompanied by strong volume, which suggests institutional participation, not just retail speculation. The moving averages are all aligned bullishly. The 50-day is above the 200-day. Price is above both. This is a classic trend-following setup that tends to persist once established. Momentum indicators are strong, but not yet in extreme overbought territory. That suggests there's room for the move to continue before you see exhaustion signals. And here's something interesting. The corrections have been shallow. When silver pulls back, it doesn't give up much ground before buyers step in. That's a sign of strong underlying demand. It's a sign that dips are being bought aggressively. Compare that to a topping pattern, where rallies get sold and corrections are deep. We're seeing the opposite. Rallies extend, corrections are shallow. That's the signature of a strong uptrend with more room to run. Now, I want to address the elephant in the room, volatility. Silver is volatile. It always has been. It's a smaller market than gold, so it moves faster in both directions. If you can't handle volatility, silver isn't for you. But here's the thing about volatility. It cuts both ways. Yes, silver can drop 20% in a matter of weeks, but it can also double in a matter of months. The volatility is the price you pay for the leverage to gold and the potential for outsized gains. And in the current setup, the risk-reward is skewed heavily to the upside. The fundamental drivers are all pointing in the same direction. The supply deficit is real and growing. Industrial demand is structural and increasing. Investment demand is just starting to wake up. The monetary backdrop is favorable. The downside risks are relatively limited. Even if we see a correction, the structural supply deficit provides support. Industrial buyers need silver, regardless of price. They can't just stop production because silver gets expensive. They have to pay whatever the market demands. So the downside is cushioned by fundamental demand, while the upside is open-ended because there's no natural ceiling on where price can go when supply is constrained and demand is surging. Let me walk you through a scenario of what could happen over the next 12-24 months. Silver is currently around $60. If the supply deficit persists and investment demand continues to build, you could see silver test the 2011 high of $49. Wait, we're already past that. You could see silver test $75, then $100. Is $100 silver realistic? Absolutely. In inflation-adjusted terms, the 1980 high of $50 would be over $180 today. So even at $100, silver would still be well below its inflation-adjusted all-time high. But here's what's different this time: the industrial demand base. In 1980, when the Hunt Brothers corner collapsed, silver crashed because there was no fundamental support. It was a speculative bubble built on leverage and manipulation. Today, if silver reaches $100, it's not going to crash back to $20 because industrial demand will provide a floor. Solar companies, EV manufacturers, electronics producers, they all need silver. They'll pay $100 if that's what it takes to secure supply. So the risk of a catastrophic collapse is much lower than in previous cycles. The downside is protected by structural demand. The upside is open-ended because supply can't respond quickly. That's an asymmetric setup. That's the kind of opportunity that doesn't come around often. Now let's talk about the geopolitical dimension, because this is adding fuel to the fire. We're in an era of de-dollarization. Countries around the world are reducing their dependence on the US dollar for trade and reserves. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working on alternative payment systems and reserve currencies. What does this have to do with silver? Everything. When confidence in fiat currencies erodes, hard assets become more valuable. Gold and silver are the ultimate hard assets. They can't be printed, they can't be debased. They have intrinsic value that transcends any particular government or currency system. As de-dollarization accelerates, as currency wars intensify, as fiscal deficits explode, the appeal of hard assets increases. And silver, being more affordable and more accessible than gold, becomes an attractive option for both institutional and retail investors. We're also seeing increasing tensions around supply chains and resource nationalism. Countries are becoming more protective of strategic resources. Export restrictions are being implemented. Trade wars are disrupting traditional supply routes. Silver is increasingly being viewed as a strategic resource, not just a commodity. Its role in the energy transition, in defense applications, in critical technologies, all of this elevates its importance beyond simple supply and demand economics. When governments start viewing silver as strategic, they start accumulating. They start restricting exports. They start prioritizing domestic supply. All of this removes metal from the global market and tightens supply further. Let me give you a specific example. China has implemented export restrictions on various critical minerals and metals. While silver isn't explicitly restricted yet, the precedent is there. If China decided to limit silver exports to protect domestic supply for their own industrial needs, it would create an immediate supply shock in the global market. The same logic applies to other major producing countries. If Mexico, Peru, or Chile decided to implement export taxes or restrictions on silver to capture more value domestically, it would tighten global supply and drive prices higher. These geopolitical risks are asymmetric. They can only tighten supply, not increase it. And in a market that's already in deficit, any additional supply disruption has an outsized impact on price. Now let's talk about what the smart money is doing, because this is always instructive. Large institutional investors have been quietly accumulating silver exposure. You can see it in the ETF flows, in the futures positioning, in the physical demand data. This isn't retail speculation. This is sophisticated capital recognizing an opportunity. Mining companies are being revalued. Silver mining stocks have been outperforming the broader market significantly. The SIL ETF, which tracks silver miners, has crushed the S&P 500 this year. That's institutional money flowing into the sector. When mining stocks lead the metal higher, it's usually a sign of a sustainable move. It means investors are betting on higher prices persisting long enough for miners to generate significant cash flows and returns. We're also seeing increased M&A activity in the silver mining sector. Larger companies are acquiring smaller producers and development projects. That's a sign that they believe silver prices are going higher and they want to secure production capacity. All of these signals point to the same conclusion. The smart money is positioning for significantly higher silver prices. And here's the thing about institutional money. It moves slowly, but once it starts moving, it's persistent. Institutions don't chase momentum. They build positions over time. They accumulate on weakness. They're patient. So when you see institutional accumulation in silver, it's not a short-term trade. It's a multi-year positioning for a structural shift in the market. Let me bring this all together and show you why the setup is so compelling. You have a market in its fifth consecutive year of structural deficit. Supply can't respond quickly due to the long lead times for new mine development and the declining grades of existing deposits. Industrial demand is at record levels and growing, driven by the energy transition and technological advancement. Investment demand is just starting to wake up as inflation concerns and currency debasement fears increase. The paper market is showing signs of stress. Physical premiums are elevated. Delivery volumes are high. The gold-to-silver ratio is historically wide, suggesting silver is undervalued relative to gold. Geopolitical tensions are increasing. De-dollarization is accelerating. Resource nationalism is rising. All of these factors tighten supply and increase demand for hard assets. The technical picture is bullish. The fundamental picture is bullish. The sentiment is shifting from skepticism to recognition. This is the kind of setup where price doesn't move in a linear fashion. It doesn't grind higher slowly. It moves in surges. It gaps. It goes vertical as the market reprices to reflect the new reality of constrained supply and surging demand. And the beautiful thing about this setup is that you don't need to time it perfectly. You don't need to catch the exact bottom or predict the exact top. The structural drivers are strong enough that positioning now, even after the move we've already seen, still offers compelling risk-reward. Because here's the reality. If silver is going to $100 or $150 or higher based on the fundamentals we've discussed, then buying at $60 versus $50 doesn't matter much. You're still capturing the majority of the move. And if you wait for a pullback that never comes, if you wait for confirmation that causes you to miss the vertical phase of the move, you'll be chasing at much higher prices with less upside remaining. The time to position is when the fundamentals are aligned but before the crowd recognizes it. That's where we are now. The fundamentals are screaming. The setup is coiling. But mainstream attention hasn't fully arrived yet. When CNBC is doing daily segments on silver, when your neighbor is asking you about silver stocks, when retail investors are piling in with both hands, that's when you know the move is mature. We're not there yet. We're in the phase where informed investors are positioning, where the smart money is accumulating, where the structural story is becoming undeniable but hasn't yet captured mainstream imagination. This is the opportunity. This is the setup. This is why silver is coiling for a vertical launch. The supply deficit is real. The industrial demand is structural. The investment demand is building. The monetary backdrop is favorable. The geopolitical winds are supportive. The technical picture is bullish. All the pieces are in place. The question isn't if silver moves significantly higher. The question is how fast and how far. And based on everything we've discussed, the historical parallels, the current fundamentals, the structural constraints, the demand drivers, the answer is faster and farther than most people expect. This is the kind of move that creates generational wealth for those positioned correctly. This is the kind of opportunity that comes around once or twice in a lifetime. The coil is tightening, the pressure is building, the launch is coming. Don't miss it.